Okay, let's just address the elephant in the room right off the bat.
Right.
It is February 2026.
Right.
And if you have looked at your portfolio in the last 48 hours, or frankly, the last 48 days, you probably need a stiff drink.
Chuckles. That's one way to put it.
The markets have been, well, interesting is the polite way to put it. Violent might be more accurate.
It's been a ride.
We are looking at Bitcoin trading in the $75,000 to $78,000 range.
Which, to be fair, if you zoom out on a 5-year chart or even a 3-year chart, is still a very healthy number.
Oh, absolutely.
It's a miracle number compared to where we were in the darker days of 2022 or 2023. We're still sitting on a massive asset class.
It is, sure. Rationally, we know that. But we have to acknowledge the emotional context here. We are coming down from that dizzying all-time high of $125,000. That is a massive haircut.
It is. The euphoria has definitely cooled off.
The tourists have left the casino, the headlines have turned sour, and now we are left with the cold, hard reality of the market.
Yep.
And for a lot of people, looking at their portfolios, it feels tense. It feels heavy.
It's a stress test, a live fire exercise. This is usually the point in the cycle where the paper hands fold, leverage gets flushed out.
Right.
And the structural engineering of these financial assets actually gets tested. It's easy to look like a genius in a bull market.
Exactly. Everyone is a genius when the line goes up. But the line has gone down significantly.
And that is why we are here.
That's exactly why we are doing this deep dive today, because back in the third quarter of 2025, which feels like a lifetime ago, honestly.
It really does.
We sat down and analyzed a very specific, very fascinating piece of financial engineering. We looked at Strategy Inc.'s series, Perpetual Stretch Preferred Stock.
The ticker is STRC.
STRC. And we've linked that previous episode in the description, specifically the part where we modeled an 80% drawdown scenario.
Right. And back then, everything we discussed was theoretical. We were looking at their waterfall model, this complex hierarchy of who gets paid and when. And we were saying, hypothetically, if the market crashes, the structure should hold. It was a paper exercise.
It was.
We were architects looking at blueprints, nodding and saying, yes, this building shouldn't fall down.
Well, the blueprints are being tested by a hurricane now.
No.
We aren't in a hypothesis anymore.
No, we're not.
We are in what you called an enormously stressed out situation. The asset underlying this whole company, Bitcoin, has taken a massive hit from the top.
A huge hit.
So the core question, the only question that really matters today is, did the failsafe work?
Does the model hold when the pressure is real? That's the question. Because it's easy to design a boat that floats in calm water. We need to see if STRC floats in a storm.
In a storm, exactly.
And more importantly, we need to see if the safeguards we identified last year are actually functioning as promised now that the price has effectively collapsed from the highs.
So here is the plan for this deep dive. We are going to reopen the case file on STRC.
Let's do it.
Welcome to the deep dive. I'm Shutosha.
And I'm Satoshi.
For those who missed our previous dive, or maybe just need a refresher, STRC is this paradox of an investment.
It really is.
It's an asset defined by the chaos of Bitcoin, yet it's engineered to produce stability, a high-yield tax-deferred dividend. It sounds like alchemy.
It is financial alchemy. It's the transmutation of risk. But alchemy can blow up in your face if you don't understand the chemistry.
A very good point. So we're going to compare two very distinct data sets to see how this thing has evolved.
Okay.
We have the theory data from the Q3 2025 earnings call, back when the company's cash reserves were actually scary low.
Yeah, that was a point of concern for us back then.
And then we have the reality data fresh numbers from January 31st, 2026. We're talking updated balance sheets, new Bitcoin counts, and updated yield rates.
And the mission is threefold. First, we need to quantitatively revalidate the big claim, the 80% drawdown protection.
Does it still hold up?
Does that still exist now that Bitcoin has already dropped? Second, we need to understand the mechanism that turns this volatility into a tax-deferred yield, which, spoiler alert, is currently sitting at 11.25%.
Which is huge. In a world where treasuries are probably yielding much less, 11.25% is an eye-watering number.
It is. And third, and this is non-negotiable for anyone listening who actually owns this stuff, we have to talk about the tax trap.
The administrative burden.
There's a specific administrative burden that comes with this investment that if you ignore it will come back to bite you hard.
Okay, let's unpack this. Let's start with the concept itself, because when I first looked at STRC, I thought, this is a shortcut.
A shortcut to what?
It's a shortcut to being well-informed about modern financial engineering because it combines everything, crypto, corporate finance, tax law, into one ticker symbol.
That's a great way to look at it.
But it's confusing. The marketing says one thing, the legal docs say another thing entirely.
It is a classic case of what I call the two-sided coin of protection.
Two-sided coin. Okay.
You have to separate the two sides because they function completely differently.
So what are the two sides?
Side one is principal security. That's the question. If the company dies, do I get my money back?
Right. My initial investment.
Exactly. And side two is dividend security. While the company lives, do I get paid? Those are two different battles.
And this is where the controversy starts. Because if you listen to Strategy Inc.'s marketing, or you listen to Michael Saylor, you hear the word backed.
All the time.
STRC is backed by Bitcoin. It's backed 7 times over. It sounds like a mortgage, right? Like there's a house collateralizing the loan.
Yep. If I stop paying my mortgage, the bank takes the house.
That's the mental model.
Exactly. It evokes the image of a secured asset, a lien. But, and this is a big but, if you open the actual prospectus, the legal document filed with the SEC.
The fine print.
The fine print. It says in black and white, unsecured obligation.
Right. So marketing says backed, legal says unsecured.
Yeah.
How can both be true? Are they lying?
No, they aren't lying. They are speaking two different languages. Legal versus economic.
Okay, break that down for us.
Let's look at the legal truth first. STRC is an unsecured obligation. That means there is no direct liener.
No direct claim on Bitcoin.
Correct. If Strategy Inc. goes bankrupt tomorrow, you, as an STRC holder, cannot walk into a court and demand the private keys to a specific Bitcoin wallet. You don't have a claim on the specific coins.
So I can't just go seize the assets.
You're not a secured creditor like a bank with a mortgage. You are a senior equity holder.
So legally, you are in line, but you don't own the assets directly.
Correct. If the ship sinks, you are a passenger with a priority ticket for the lifeboat, but you don't own the lifeboat itself.
That's a great analogy.
But then you have the economic truth, and this is where the backed claim comes from. Strategy Inc. isn't a software company anymore, really.
Not at all.
It is a Bitcoin treasury. That is the business model.
It's a giant vault. That's all it is.
Effectively, yes. Look at the data points. Back in Q3 2025, they held about 640,000 Bitcoin. Now, as of January 2026, they hold 713,502 Bitcoin.
Wow, so they've been accumulating more.
A lot more. And that is a staggering amount of liquid assets. So the argument is that while you don't have a legal leader on those coins, the sheer size and liquidity of that asset pool economically back your investment.
So it's backed by the fact that the vault is full, even if I don't have the key to the vault.
That's a perfect way to put it. And because the asset Bitcoin is highly liquid, it can be sold to pay you if necessary. That's the economic reality.
Right. It's not like they're backed by, I don't know, patents or brand value.
Exactly. A software company might have assets like intellectual property or brand value that are hard to sell in a crisis. Bitcoin is liquid 24/7/365. That liquidity is the economic backing. It turns the company into a giant piggy bank that can be smashed open if needed.
Okay, that makes sense. But for that economic reality to actually protect you, there has to be a system, a hierarchy.
Yeah.
We call this the waterfall model. And I want to visualize this for the listener. Imagine a literal waterfall of money flowing down through the company.
Right. In a liquidation scenario, meaning the company is closing shop and paying everyone out, the money starts at the top and flows down.
And you want to be high up.
You want to be as high up that waterfall as possible. The higher you are, the drier you stay, or rather, the more likely you are to get wet with cash.
So, who is at the top? Tier 1. Who gets paid first no matter what?
Tier 1 is senior debt. These are the convertible notes. As of our latest data, that's about $8.24 billion.
$8.24 billion.
They get paid 100% of what they are owed before anyone else sees a dime. That is the law. Bondholders first.
Okay, so $8.24 billion is off the top. Gone. Who's next in line?
Tier 2A. This is the STRF preferred stock. It's another series of preferreds, slightly more senior than our subject today.
Okay, and how much is that?
That's about $1.26 billion.
Okay, so we are nearly $10 billion deep now. Who is next? That's a huge amount of money.
It is. And next is Tier 2B. This is our subject today. STRC preferred stock.
Our focus.
Our focus. The liquidation preference here is $2.8 billion.
So STRC is sitting there in the middle. But below it, there's more, right? And this is crucial because if STRC was at the bottom, I'd be terrified.
This is the most critical part of the design. This is the genius of the engineering, really.
Okay.
Below STRC, you have Tier 2C, the junior preferreds STRK and STRD.
And that's another layer.
That's a $2.64 billion layer. And below them, at the very bottom, Tier 3, is the common stock MSTR.
We call those junior preferreds the shock absorbers, don't we?
We do, and it's a deliberate architectural choice. Why does Strategy Inc. have these junior preferreds? Why create a layer of stock that sits explicitly below STRC?
To protect it.
It's to give institutional investors comfort. When you look at the waterfall, you see a $2.64 billion buffer, plus all the common stock that has to be completely wiped out before STRC loses a single penny of principal.
It's like a crumple zone in a car. You want that front end to smash up so the passenger cabin STRC stays intact?
Precisely. The junior preferreds are designed to take the impact. They are the airbags. They get sacrificed for the good of the senior tranches.
Okay, so that's the theory. That's the blueprint. That's the waterfall structure we mapped out last year.
That's the design.
But now let's pressure test it. Let's do the live fire stress test with the January 2026 data. Because theory is nice, but I want to know if I'm safe now.
Now in the real world.
This is the core of our update. The previous episode, we ran the 80% drawdown from the all-time high. Now we need to run it from today's reality.
Let's run the numbers. And I want to be clear, we aren't using rosy numbers here.
No, we need the worst case.
We are going to use the nuclear winter scenario.
Setting the scene again, it's early February 2026. Bitcoin is trading around $78,621. We are down significantly from the highs.
Yep.
The host challenge here is simple. Is that buffer eroding? Is the crumple zone already smashed?
To find out, we have to simulate the worst case scenario, the famous 80% crash. But we aren't calculating 80% from the all-time high of 125K. That's old news. That pain has already happened.
We're already living in that reality.
We are going to simulate a further 80% crash from right now from the current $78,000 level.
Oof. Okay, just to be clear, you are saying, what happens if Bitcoin drops 80% from today?
From today's price.
So we aren't going back to 25K, we are going much, much lower.
Exactly. That puts Bitcoin at approximately $15,724.
$15,000.
We are talking about a catastrophic crypto winter, a complete desolation of the market, regulatory bans, exchange failures, the works.
If Bitcoin hits 15K from here, there's blood in the streets.
There is. So let's see if the structure survives even that.
$15,000 Bitcoin.
Yeah.
If that happens, my portfolio is dust. But what is the Strategy Inc. vault worth?
Let's do the math. They hold 713,502 Bitcoin.
Okay.
Multiply that by $15,724. The Bitcoin assets are now worth roughly $11.22 billion.
That doesn't sound like enough. Didn't we say the debt and senior stuff was like $10 billion?
It was.
I'm doing mental math here and getting nervous. It feels like we are underwater.
Hold on. This is the twist. This is the critical update in the Jan 2026 data that changes everything.
Okay.
This is the piece of the puzzle that wasn't there in 2025.
What is it?
The cash.
The cash.
The cash. In Q3 2025, when we first looked at this, Strategy Inc. was cash poor.
I remember that.
They had like $54 million on hand. It was scary low. They were basically living paycheck to paycheck in terms of corporate liquidity.
It was a huge red flag for us.
It was. But in January 2026, their balance sheet shows cash reserves of $2.25 billion.
Wait, $2.25 billion in cash, just sitting there.
It's just sitting there. Fiat currency,
Yeah.
USD. In short term, treasuries and cash equivalent.
That is massive. That's a fortress. Where did that come from?
They raised it during the bull run. They sold common stock when the price was high and stuffed the war chest.
Smart.
Very smart. And that cash changes the entire liquidation equation.
Yeah.
So take the Bitcoin value of $11.22 billion. Add the $2.25 billion in cash. The total liquidatable assets are now $13.47 billion.
$13.47 billion. Okay, now I feel a little better. Let's pour that down the waterfall.
Step 1, pay the senior debt. That's $8.24 billion.
Oh, you have enough.
We have $13.47 billion.
Sure.
Debt is paid in full. Remaining pot, $5.23 billion.
Okay, debt is clear. Step 2.
Pay STRF. That's
Yeah.
$1.26 billion. We have $5.23 billion.
Still plenty of room.
STRS is paid in full. Remaining pot, $3.97 billion.
Step 3. The moment of truth. STRC.
STRC's claim is $2.80 billion. We have $3.97 billion sitting there.
So
And there's still money left over.
roughly $1.17 billion left over.
So who gets that? Does that go to STRC holders?
No, STRC gets its principal back, nothing more. That leftover cash goes to the shock absorbers, the junior preferreds.
Ah, the crumple zone.
Their claim was $2.64 billion, but there's only $1.17 billion left. So they take a haircut, they get about 44 cents on the dollar.
And the common stock, MSTR. Zero.
Yeah.
Wiped out completely. The equity holders go home with nothing.
But STRC walks away whole.
STRC walks away whole, and that is the fail-safe verdict. Despite Bitcoin dropping from 125K to 75K, the model actually got stronger.
Stronger. How is it possible to be stronger when the asset price is lower?
Two reasons. One, they accumulated more Bitcoin 7 and 13K versus 640K. Volume matters.
Right.
But primarily it's that cash. That $2.25 billion cash injection raised the floor of the entire company.
It's just like they reinforced the hull of the ship while it was taking on weights.
Exactly. If you run the math to find the absolute break-even point, the price where STRC principal starts to lose money.
Or starts to hurt.
Right. It's now all the way down at roughly $12,500 per Bitcoin.
$12,500. That is reassuring.
It is.
I mean, if Bitcoin goes to 12 grand, we have bigger problems globally? Probably.
Probably, yes.
But knowing the structure holds to that level is impressive. It's significantly better than the protection offered by most junk bonds or even some investment-grade corporates in a recession.
Yeah. It validates the engineering. The fail-safe held at 75K, and it's prepared to hold much lower.
So, principal security, check. That box is ticked. We have proven, mathematically, the money is safe in a liquidation.
As safe as you can get in this kind of market.
But now we have to talk about the other side of the coin. Dividend stability. Getting your money back in a disaster is great, but people buy STRC for the income.
They want that check.
They want that monthly check. They want the yield.
Right. And here is where things get interesting in the January data. Look at the yield.
Okay.
In November 2025, the dividend rate was 10.5%. But as of February 1st, 2026, it is 11.25%.
That's a jump. And usually when I see a yield jump like that, I get nervous.
You're right to be.
In the bond market, when yield spikes, it means prices tanked and the market is scared. Is Strategy Inc. desperate? Are they raising the rate because people are fleeing?
No, this is the mechanical stabilizer at work. This is a feature, not a bug.
Mechanical stabilizer.
We have to remember, STRC isn't a fixed rate bond. It's a stretch preferred, which means it has a variable rate. The rate adjusts based on the trading price to keep the stock near its $100 par value.
Explain that mechanism. How does it know to change?
It's algorithmic. If the trading price of STRC drifts down, say, to $99.10, which is where it was recently.
You're trading at a slight discount.
A slight discount. The formula kicks in. It says, hey, we are trading below $100. We need to make this more attractive to buyers to push the price back up, so it automatically ticks up the dividend rate.
So the price drops slightly, and the yield went up to compensate. It's like a self-correcting system.
Exactly. It's a feedback loop designed to reduce volatility in the share price, and it worked. The yield went up to 11.25%. Buyer said, I want that yield. They stepped in, and the price stabilizes.
So it's not desperation. It's the machine functioning as designed.
Precisely.
Okay. So the high yield is a feature. But here's the question that always nags at me. Solvency versus liquidity.
The classic dilemma.
We prove the principal is safe. That's solvency. The assets exceed the liabilities. But liquidity is about having cash today to pay the bills.
Correct. You can be solvent rich in assets, but illiquid broke in cash and still go bankrupt. It happens all the time.
And Strategy Inc. has a massive bill. They have a $640 million annual dividend bill. That's a lot of cash going out the door every year.
It's a huge commitment.
And their policy is never sell Bitcoin. So where does the cash come from?
This is the circular funding risk. And this is the most sophisticated and perhaps the most fragile part of the whole engine.
No.
To pay that $640 million without selling Bitcoin, they rely on the circular funding model.
Which is?
They issue common stock MSTR, they print new shares, sell them to the market to raise cash, and use that cash to pay the dividends on the preferred stock.
So they are diluting the common shareholders to pay the preferred shareholders.
In essence, yes. But as long as the common stock price is high, or at least has demand, it works beautifully. The common shareholders accept the dilution because they want the leveraged Bitcoin exposure.
But what if the market freezes? What if we are in a deep recession and nobody wants to buy MSTR stock, or the SEC halts trading? What happens then?
That is the nightmare scenario. We call it the death spiral.
Walk us through the death spiral. I want to feel the fear here.
Okay. Imagine equity markets freeze. Strategy Inc. cannot issue new MSTR shares. But the bill for the dividends is due. They have $640 million to pay.
They need the cash.
If they don't have the cash, they have to break the never sell rule. They have to sell Bitcoin.
And selling Bitcoin in a crash is bad.
It's catastrophic for tax purposes. Their average cost basis is around $74,000 per Bitcoin.
Right. They bought a lot of it high.
In our crash scenario, price is $15,000. If they sell at $15,000, they are realizing a massive loss. But more importantly, selling the asset erodes the equity value.
Because the vault is getting emptier.
The market sees them selling, panics, drives the stock down further, which makes it even harder to raise money. It spirals down until the company eats itself.
This is where that Q3 2025 versus Jan 2026 comparison blows my mind.
It's night and day.
In Q3, they had $54 million in cash. That's like 1 month of runway. They were living paycheck to paycheck on the equity markets.
They were walking a tightrope without a net. If the market sneezed in Q3 2025, they were in serious trouble.
But now
they have $2.25 billion in cash.
That's a firewall.
It is a massive one. Even if the equity market's completely close, if nobody buys a single share of MSTR for 3 years.
3 years.
For 3 years, Strategy Inc. can just reach into that $2.25 billion pile and pay the dividends. They don't have to sell Bitcoin. They don't have to issue stock. They can just wait it out.
So that massive cash pile essentially neutralized the death spiral risk for the foreseeable future.
Exactly. It transformed the risk profile. It went from a month-to-month survival game to a multi-year fortress.
And that's why you said the model is stronger now.
That is why the model is stronger now. Even with Bitcoin price down, the cash buys them time. In financial crises, time is the only asset that matters.
That is a crucial insight. It's not just about how much Bitcoin they have. It's about how long they can hold it without being forced to sell.
That's the whole game right there.
Okay, let's pivot to the tax stuff. Because we mentioned financial alchemy earlier, and usually that refers to the return of capital, or ROC.
The double-edged sword.
The 11.25% yield is tax-deferred. For a high earner, that is gold.
Oh, it's huge.
If you're in a 40% or 50% tax bracket, getting 11% tax-free is like getting 20% in the taxable world.
The math is very compelling.
Explain the mechanism again. How is it legal to pay a dividend and not have it taxed as income?
It all comes down to a concept called earnings and profits, or ENP, for tax purposes.
ENP, okay.
In the eyes of the IRS, a company only pays a dividend, which is taxable as income, if it has generated accounting profits.
And Strategy Inc.
Strategy Inc. doesn't sell its Bitcoin. So even if Bitcoin goes up $1 billion, that is an unrealized gain.
It's just on paper.
It sits on the balance sheet, but it doesn't count as taxable profit because they haven't sold. So when they send you cash, the IRS looks at their books and says, well, they didn't make a profit, so this cash they sent you isn't income. It must be them just giving you your own money back.
Return of capital.
Right. It's not income. It's a refund of your original purchase price.
So if I get $1,000 in dividends from them this year.
You pay zero tax on it this year.
Zero.
Zero tax this year. That's the benefit. You get the cash flow now, tax-free. You can spend it, reinvest it, do whatever you want with it.
I don't feel a but coming.
There is always a but.
Yes,
you are borrowing from your future self. Because that $1,000 reduces your cost basis.
And this is the audit me trap we warned about in the intro.
This is non-negotiable, so listen carefully. This is where people get burned.
Okay.
Your broker, Schwab, Fidelity, whoever, will send you a Form 1099 DIV. In box 3, it will say non-dividend distributions. That is your ROC.
Okay, I see the number. What do I do with it?
You have a manual task. Most brokers do not adjust your cost basis automatically for ROC on preferreds like this. It's up to you.
I have to do it myself.
You must take that number and subtract it from the price you paid for the stock in your own records.
Give me an example. Real numbers.
Okay. You buy 1 share of STRC for $100. Over the year, you receive $11.25 in dividends.
Okay. Cash in my pocket.
You pay no tax on that $11.25 now. But you must open your spreadsheet or your tax software and lower your cost basis. $100 minus $11.25 equals $88.75.
So my new tax basis for that share is $88.75.
Correct.
Why does that matter?
Because 3 years later, let's say you sell that share for $100. You might look at it and think, I bought it $100, sold it $100, I made zero profit. No tax.
Right. Break even. Easy.
Wrong. The IRS looks at your adjusted basis. They see $88.75. They say you sold for $100, your basis is $88.75, you have a capital gain of $11.25. You owe tax on that $11.25.
And if I don't report it, if I just report the $100 basis, because that's what I remember.
The IRS has the 1099 forms. They know you got the dividends. Their computer system matches the non-dividend distributions to your tax return.
So they see the mismatch.
They see the discrepancy that you effectively ignored the ROC, and it flags you. That is the audit me flag. You are technically misreporting income.
So the tax isn't gone, it's just pushed to the end. It's deferred until the sale.
Correct. And usually, that's great. You get to pay long-term capital gains rates, which are lower instead of ordinary income tax rates, and you get to use that money in the meantime.
So it's still a benefit?
It's a huge win. The time value of money is on your side, but only if you do the paperwork.
It's the responsibility tax. You pay with your time and attention. If you are lazy or disorganized, this investment will cause you a major headache.
Well put. It's a sophisticated instrument for sophisticated investors who track their own books.
All right, let's zoom out for the final section. We've talked about how safe STRC is. We've talked about the catch fortress, the 80% protection, the tax benefits. It sounds almost too safe. Like, where did the risk go? Bitcoin is volatile. STRC is stable. Energy cannot be created or destroyed, right? Conservation of risk?
Exactly. The law of physics applies to finance. The volatility didn't disappear. It wasn't destroyed.
So where did it go?
It was transferred. It was concentrated and amplified onto the common stock MSTR.
Poor MSTR holders.
Well, not necessarily poor. They signed up for it. They know the deal.
True.
Think of it this way. Strategy Inc. took a volatile asset, Bitcoin, and sliced it into two products. Product A, STRC, is for the person who wants safety and yield.
The person who needs to pay rent.
Exactly. And product B, MSTR, is for the person who wants supercharged action.
You use an analogy in our pre-show notes. The leveraged call option. I love this. Break it down.
MSTR common stock functions mathematically like a leveraged call option on Bitcoin.
Okay, an option usually has a strike price. What is the strike price here?
The strike price is the fixed annual liability, that $640 million dividend bill we talked about. That is the hurdle. Strategy Inc. must pay that $640 million every year before the common stockholders get a single penny of value.
So that dividend payment is the bar they have to clear.
Right. Now think about the leverage. In a bull market, let's say Bitcoin moons, the assets go up by billions of dollars.
Okay.
That $640 million payment stays fixed. It doesn't go up. It becomes a tiny percentage of the total assets. So all that surplus value, the billions in gains, flows directly to the common stock.
So MSTR goes up faster than Bitcoin.
Much faster. It captures 100% of the surplus. That's upside leverage. That's why people buy MSTR. They want the turbo boost.
So the sword cuts both ways.
Oh, does it ever? Downside leverage. In a crash, like we've seen Bitcoin drops, the asset value shrinks. But that $640 million bill, it stays exactly the same. It takes a huge bite out of the shrinking pie.
So the equity gets eaten alive.
Rapidly. That is why MSTR is so volatile. It is absorbing the volatility that was removed from STRC. It is the designated volatility sponge.
That is a fascinating way to view a company. It's not just a business. It's a structured financial product. They engineered boringness for one group by engineering chaos for the other.
It's called tranching. It's the magic of Wall Street. You create different appetites for risk from the same cow. One guy gets the steak, the other guy gets the burger.
Or one guy gets the milk and the other guy rides the bull.
Oh, yeah, that's like that better, yes. STRC is the milk. MSTR is the bull ride.
So we've covered the financial alchemy, the waterfall, the live fire test, the tax trap, and the risk transfer. It seems like the January 2026 data really vindicates the model.
It does. The 80% drawdown protection holds all the way down to $12,500. The cash reserves have bulletproofed the dividend against a death spiral.
It's a robust machine.
It is. It survived the drop from 125K to 75K without a scratch. In fact, it got stronger.
It's impressive. But before we wrap up, I want to hit you with a final thought, a provocation.
Let's hear it.
We are looking at the limits of financial engineering here. We took the most volatile asset on earth, Bitcoin, and turned it into a boring, tax-efficient annuity. What is the next step? Where does this go?
The thought experiment.
Exactly. Imagine this. Strategy Inc. takes 50,000 Bitcoin. They lock it in a separate vault, ring-fenced, legal firewall. Nobody can touch it.
A segregated pool of assets.
So they go to a government, maybe the U.S., maybe someone else, and they say, guarantee the payments on this.
The sovereign Bitcoin bond.
Right. If you had a government guarantee on the payments, backed by a ring-fenced reserve of Bitcoin, could you create a perpetual sovereign Bitcoin bond?
You are talking about merging the stability of the state with the volatility of the asset.
Why not? Is it that crazy?
It's the ultimate financial alchemy. If you could pull that off, You aren't just creating a stock, you are creating a new form of reserve currency.
A treasury bill that yields 11% and is backed by digital gold.
The implications of that are staggering.
It sounds sci-fi, but looking at STRC today, it doesn't feel that far off.
We are witnessing the evolution of asset classes in real time. We are watching the primordial soup of a new financial system.
We really are. Okay, that brings us to the end of this deep dive, but I have one more specific call to action for you, the listener.
The internal debate.
Yes. We had a debate this week. We were looking at our numbers and realized something crazy.
I think it's embarrassing.
Only 2% of you are subscribed. 2%. Now, we want to do more. We want to take these waterfalls, these tax basis calculations, and visualize them. We want to make videos.
Seeing the waterfall makes it click in a way audio sometimes can't. You can see the money flowing down.
Exactly. But to do that, we need tools. We are looking at Mosaic AI, this incredible video editor that can visualize this data automatically. But we need to hit a milestone to fund it.
And that milestone is?
We need 1,000 subscribers.
That's the threshold.
That is our strike price. So if you found value in this, if realizing you need to adjust your cost basis just saved you from an IRS audit, please hit that subscribe button.
Help us get the tools.
Help us engineer our own growth.
Help us build the waterfall.
Exactly. Thanks for listening to The Deep Dive. We'll see you next time.
Keep searching.
I'm Shutosha.
And I'm Satoshi.